I am Nicolas Bornozis, President of Capital Inc., and I would like to welcome you to Capital Inc.'s Trending News webinar series. It is our pleasure to welcome today Mr. Hamish Norton, President of SBLK Carriers. SBLK recently announced its second quarter 2025 results, and we are going to discuss the company's latest developments, strategy, and the dry bulk sector outlook. As a reminder, SBLK is a global shipping company providing worldwide seaborne transportation for dry bulk cargoes. It is listed on NASDAQ under the ticker SBLK, and as of August 6, on a fully delivered basis, the company's fleet includes 142 dry bulk vessels. Now, before we begin our discussion, please note the usual disclaimer, which we have in detail on the opening slide, that this discussion is only for informational and educational purposes, and it is not investment advice or advice of any kind or an offer to buy or sell any securities. And as an additional disclosure, Capital Inc. is very proud to serve as the investor relations advisor to SBLK Carriers. So with this, I would like to welcome Hamish. Thank you for joining us today. We appreciate your taking the time to be with us and have this discussion.
Thank you, Nicolas.
So I am going to start with, let's focus first on the fleet profile. During the quarter, you agreed to sell 9 smaller, older, and less efficient vessels, plus 2 more in July, with an aggregate gross proceeds of about $104 million, minus roughly $19 million in associated debt repayments. So when it comes to selling or buying ships, how do you decide which ships to sell? And given your view that asset prices are currently high, what would make you consider stepping back into acquisitions?
Well, so we think the prices that we're getting for the ships we're selling are actually relatively high for these vessels and are very attractive. We're selling the older and smaller vessels, which are not producing great cash flows now. Which we think, based upon their age and fuel consumption, are not likely to produce really exciting cash flows in the future. And these ships, frankly, every ship that's currently afloat will be paying penalties to the IMO soon enough. And we think this is the time to sell those ships. Now, we don't think that every ship is too expensive. There are certain sorts of ships that we actually are thinking about buying even right now. But it would be nice to get our share price up a bit, if we could do that first.
Well, as I mentioned in the opening statement, your fleet is 142 vessels with an average age of 11.9 years. So fleet maintenance and renewal are especially important given the tightening environmental regulations that you alluded to. So how do you go about upgrading and renewing your fleet?
Okay, it's a very challenging topic. Every ship owner is thinking very hard about this. There are 2 things that we're thinking about. One is, when would be the time to order new buildings? The world is going to need new ships to comply with the, relatively stringent IMO regulations. But these ships are clearly not just going to burn fuel oil. They have to use a low carbon fuel, ideally a 0 or near 0 carbon fuel. There aren't too many such fuels available. And the ships that burn these fuels can be ordered. Not all the ammonia engines that will be available next year are available yet. But you can order a ship that can burn ammonia and fuel oil. You can order a ship that can burn bio LNG or biomethanol and fuel oil. It's a challenge to think about where and when we'll be able to get these fuels. And it's also a challenge because the shipyards are very full of orders for container ships, LNG carriers, and other ships, all of which are more profitable for the shipyard to construct than our relatively simple dry bulk carriers. So the shipyards have not been in a mood to cut prices to get dry bulk orders. And, we think the new building prices for dry bulk ships are really quite high. So, a modern dry bulk ship is a challenge at the moment. What's sort of interesting are older, large ships, which are getting high charter rates now. And, you don't have to think as much about the IMO penalties in the future for such ships because maybe, after 5 years of use, you can scrap them and make a profit. So, that's sort of how our thinking is going. It's
But you are doing quite an extensive upgrade program on your fleet.
Absolutely. We ordered, last year, 5 very advanced Kamsarmax vessels at a very good price and with extremely high specifications. And those are coming in next year. And we think those will contribute quite a bit.
And the fleet in the water, as I have seen in your presentation, you do take a number of measures to improve.
Oh, yes, absolutely. Yes, we are adding energy saving devices to the ships. Basically, ducts that go just in front of the propeller that optimize the flow of water before it gets to the propeller so that the propeller can exert maximum propulsive force with the water. And then we're also reducing the size of our propellers on many of the ships. The propellers were optimized for pushing the ship at 14 knots. No ship goes 14 knots nowadays. The fuel costs too much to go 14 knots. So the reduced size of the propellers optimizes them to go between 11 and 12 knots. And between the energy saving ducts that we're putting on the ships and the reduction in size of propellers, we're able to save about 10% of the fuel. In addition, we're paying a lot more attention to the paint quality. Low friction paints, when properly maintained, can save you easily 5% of your fuel. And we are trialing robotic hull cleaning machines that can be deployed by the crew to keep the hull clean, basically. And a clean hull is almost more important than anything else. It is very, very common that a hull can get fouled enough to slow the ship down, to basically cause at a given speed 10, 20, even 30 or more percent more fuel consumption, which is a huge effect. At the same time, in operating the ships, we have a vessel performance monitoring team that pays attention to the efficiency of the engine, the propeller, and the hull. And also, we use a very advanced service that optimizes our route and speeds for the weather conditions that that we're going to find along our route, and it actually anticipates future weather so that we can change our route and change our speed to avoid hitting weather that would be either unsafe or would cause us to burn more fuel than necessary.
Well, thank you for this very detailed reply. I think before I move to the next question, I think it's important for our listeners to take away that yes, fleet renewal with new buildings is one way to go, but at the same time, what you mentioned, if we add all the savings together, upgrading the existing fleet can result into very significant cost savings and environmental and reduction.
No, absolutely. I mean, some of these things pay for themselves pretty quickly just with fuel saved. But the economics of doing a good job on this sort of, basically optimization of the existing fleet, the payback is much quicker under the proposed IMO regulations.
Thank you. By the way, I had a question on that. How are you? What is the expected impact of the environmental regulations on the industry as a whole, and Starbucks in particular? But I mean, we are talking about the IMO MEPC meeting in October, new regulations coming on board. What is the landscape here?
Well, if we didn't do something about it, if we went into the IMO regime with our current fleet, as currently construed and with current fuel consumption, it ends up being hundreds of millions of dollars for Starbucks. It's billions and billions of dollars for the industry as a whole. And I am hopeful that the IMO is spending a lot of time and energy figuring out how to collect and invest and deal with this very large amount of money that it is proposing to collect. It's a very challenging job that they face. They're going to become basically a bank. And there is a proposal to return some of that money anyway to ship owners who employ ships that burn zero or near zero carbon fuel. Those regulations have not been actually even proposed yet. So we don't know what's coming, but to burn ammonia or biomethanol is going to be very costly, and it will require a substantial reward from the IMO, in addition to the penalties that the IMO is putting on carbon emissions.
Thank you. Now, let me move to the next topic, capital return policy and share buybacks. So here, you recently renewed the 100 million share repurchase program after buying back approximately 3.3 million shares in the second quarter for 54 million at prices that you have suggested were well below the NAV. So how do you decide when to allocate cash toward buybacks versus keeping more liquidity for other opportunities?
Mm-hmm. Well, shipping is a very cyclical business, and we are very mindful that buying back stock with operating cash flow is making a bet, and we prefer not to make bets. We prefer to take pure arbitrage profits with no risk. And so if we see that we can buy in shares at a price that is substantially below the implied share price that would exist if the share were valued at the net, liquidation value of the company, if we can basically sell ships, if we are confident we can sell ships at a price that's higher than the price of the share we're buying in by a reasonable margin, we are inclined to buy back shares and sell ships to fund it. And regardless of the economic situation of the world, going forward, that was a good trade. That makes money for the shareholders. When the share price gets closer to the price at which we think we can sell ships, then we're inclined to maybe keep that money for a better opportunity, because you can have a good opportunity, but if you expect a better opportunity, that probably makes sense for the shareholders to wait for that better opportunity that you expect to have available.
Thank you. Now, if you allow me to dig a bit deeper on this topic, on the call, you mentioned that if the share price is lower, you might use cash flow or proceeds from vessel sales to buy back stock. But if the price is stronger, you might prefer to build up cash reserves for future opportunities. So can you expand a little bit on how you determine what is cheap versus fully valued, what it looks like for Starbucks shares that you have as a benchmark or a reference?
Okay, so to use operating cash to buy back shares, it has to be very cheap. The share price has to be, so low that we think this is stupid. It's not a risk to buy shares with cash flow. If the share price is somewhat higher, we'll use operating cash flow to pay dividends. Of course, we intend to continue paying dividends, perhaps for as much as 60% of our operating cash flow. But in terms of buying back shares with the remainder or paying down debt or keeping the cash for future opportunities, again, if the share price is ridiculously low, we will use operating cash to buy back shares. Yes, although we prefer, as I said, to take pure arbitrage profits for our shareholders. Then obviously, if the share is above, what we think the value of the assets is, that is our indication that the shareholders are in a mood to have us expand. And then we would use our cash flow to make investments. In the middle, which is by and large where we find our share price, at the moment we think it's probably most attractive to use operating cash flow to pay dividends and to put aside for what we think will be better opportunities to invest.
Thank you. Now, going into the next question in this topic, I'd like to give a reminder to our listeners that in your second quarter 2025 earnings presentation, you showed that since 2021, Starbucks actions resulted in $2.75 billion in shareholder value creation. And you broke it down, indicating that $1.4 billion went to dividends, $876 million went to debt repayment, and $518 million in share buybacks. So as of August 4th, when you did the announcement, cash stood at $407 million, with net debt of $761 million, against the scrap value of the fleet for $932 million. So fairly robust, financial condition. So given all this context, how should investors think about the role of the dividend alongside buybacks in your overall capital return strategy?
Okay, well, so first of all, we continue to repay about $250 million of debt per year. We're basically not refinancing our bank debt as it amortizes. So we're reducing the risk on the company's balance sheet. We're also building up some cash. We have a very substantial cash balance of over $400 million. We continue to think dividends are very important. We have some large shareholders on the board who value their dividends. We have some large shareholders who are not on the board whom we know value their dividends. And we intend to continue paying substantial dividends, obviously larger when we make more profit. I think buybacks we will continue to fund primarily with proceeds of vessel sales. As between dividends and other uses of cash flow, probably most of the cash flow that we don't pay out as dividends will be probably at this point put aside for potential future opportunities, which we think will be very attractive.
Thank you. So now let me go to the last section of our discussion, the market outlook and supply and demand. So In the call, the earnings call, you spoke about an ocean imbalance with more ships in the Pacific and fewer ships in the Atlantic, and that helped lift the market. Now, do you see that this imbalance will continue into 2026, and how does it affect the way that you deploy your fleet?
So we think that the ocean imbalance on Capesize and Panamax vessels, particularly, is going to be very hard to reverse before February of 2026. And this imbalance of fleet capacity seems to occur around April or May of every year, and it extends until December or January. As Atlantic long haul exports increase and the number of ballasters from the Pacific, are inevitably limited. We think it's going to reappear next year, but it's unlikely in our view that it's going to be as strong as it was in 2025. But it might, it's hard to predict. And so, our chartering department tries to keep the ships in the Atlantic to the extent possible. Obviously, when you have a ship in the Atlantic and the cargo takes you to the Pacific, there's nothing much you can do about that. But what we try to do is get cargoes that will take us into the Atlantic during the period when we anticipate this so-called ocean imbalance to be at its strongest. And it works, to some extent. I mean, there's a limit to how much we can actually do.
So you also mentioned that historically the second half of the year accounts for around 54% of the dry bulk trade versus 46% in the first half. So given the current market conditions, do you think that the seasonal uplift will be stronger than usual this year?
We actually do think it's going to be stronger than usual. Chinese imports went through a major destocking. I mean, basically their inventories dropped during the first half of the year, and we think they're likely to rebuild their inventories of various commodities during the second half of the year. Particularly, we expect an improvement in coal and grain movements during the second half of the year. But basically, the first half was extremely weak for coal and grain. And then, Brazilian iron ore is relatively seasonal, and we think there will be an increase month over month of Brazilian iron ore. And the Simandou mine in Guinea will start moving iron ore in the fourth quarter of this year. Um, you know, Minor bulks, we think are going to maybe not create as much difference because they performed quite well during the first half. And we think that the Trump tariff considerations probably caused substantial movements in the first half, trying to beat the tariffs. But hard to predict with
You
minor
brought me to,
bulks.
you brought me to the next question that you pointed out that June exports hit an all-time high, partly due to cargoes being expedited before tariffs take effect. And you just touched on tariffs. So how sustainable do you think that this momentum is, and what risks do you see from the tariff side, if any?
Our business is very little impacted directly by tariffs. Um, you know, uh, we we move very few cargoes to the United States. We move coal and grain out of the United States, um, but of course there are no tariffs on that. Um, and the big risk from the tariffs is the world economy. If the tariffs cause a drop in global GDP or cause global GDP to grow less than it otherwise would, that's going to affect our business. So far, the evidence for that is very slight, but of course, tariffs have largely not been in effect yet. So let's hope for the best.
So your presentation shows a 2026 forecast for the dry bulk trade to grow at the rate of 0.3% in tons and 0.6% in ton miles, against the backdrop of a fleet where the order book is just 10.8% and nearly 28% of the vessels are over 15 years old. So what's driving your optimism for a relatively good year? Is it more about the supply side staying tight, or are you expecting stronger demand growth as well?
The supply side is very, very tight, particularly for Capesize ships. And ordering is not taking place, despite the aging fleet, and in some sense, despite the environmental regulations at the moment. You know, the various environmental rules are certainly also persuading people that they should steam slower, and that decreases the effective size of the fleet. Um, you know, the shipyard situation, as I mentioned before, is very makes life very difficult for companies that wanted to buy Capesize ships because the prices are just very high. But also, the IMO rules that were, the proposed regulations that were published earlier this year, mean that LNG powered ships are not given much advantage over fuel oil powered ships. And that's awkward because LNG powered ships have become very common. The supply of LNG is getting more and more widespread. And now it looks like LNG is not going to be very attractive under the IMO regulations, and you will have to go to a more exotic fuel in order to avoid significant payments. So, I think that has caused a pause in dry bulk ship ordering. Because dry bulk goes not from it's not like container lines, which have a fixed route and call it large ports. We call it thousands of ports all over the world, not all of which have very much capital improvement, not all of which have access to any fuel other than VLSFO. So it's a very hard problem for the dry bulk industry to solve. And I think that has caused hesitation in ordering new ships, which is a good thing for the industry.
So, Hamish, if I can paraphrase what you're saying, it seems that the supply side is going to play a very important role into the equation, because here we can be more certain in terms of the dynamics, the order book, the aging fleet, the regulations coming on board. So that clearly is a positive sign that will impact the industry. And on the demand side, you also seem to be relatively optimistic. So balance.
Look, I think demand tends to grow with global GDP. And we think will be faster than that in 2026, basically because Simandou mine is going to start producing a lot of iron ore, which is a very long way from its home market, which is basically China. And we see Brazilian exports increasing. They're their production capacity is growing, and that's going to make a big difference in total ton miles. Even if the total volume of iron ore shipped is unchanged, that's going to create a lot more ton miles because of the distance that the iron ore has to travel. And there have been a lot of wars this year. If some of these wars stop and there's reconstruction takes an enormous amount of dry bulk. It's astonishing how much dry bulk you need to reconstruct cities.
Yeah, and we have a number of very big areas that hopefully peace will come back to, and they will need reconstruction, and obviously that will be an additional positive for the industry. Anyway,
Yes.
so I'd like to thank you very much. Your insight is always particularly valuable. Thank you for being with us today. Before we close the discussion, do you have any closing remarks?
Yeah, only to say that we think that Star Bulk is an exceptional opportunity as currently priced.
Yeah, we have had this discussion about the endemic discount in shipping between NAV and stock prices, and so thank you for alerting us to this again. So thank you,
Thank you.
to everybody for being with us. Thank you, Hamish. And as a reminder to everybody, this will be on Capital Link's webinar website, www.capitallinkwebinars.com, and of course on Capital Link's YouTube channel. Thank you very much to everybody for being with us. Thank you, Hamish.
Thank you.